Good day, everyone. My name is Antoon Schneider. I am a senior partner at the Boston Consulting Group, and I lead our private equity and principal investor practice here in the UK. And with me for this panel session, I have a very distinguished panel, I'm glad to say, sitting next to me. I will be very brief in my introductions for my panel members. First, you've got Raul Sotomayor, who is a member of the executive committee and a partner at Southern Cross Group, one of the longest-standing private equity firms in Chile and in South America. We have Carlos Sahe, who is the CEO of Tuesca, a very large asset management company focusing on real estate assets and infrastructure-type real assets with more than $1 billion under management. And then following from that, we go to the secondary part of the market with Jose. Jose is a partner at Lexington Partners. I think you're familiar, one of the world's leading investors in secondaries and co-investment assets in private equity. And finally, but not least, Cristobal Torres, who is a manager of one of the largest, I should keep going. Oh, going the wrong way. There we go. Cristobal of Provida, a large pension fund, which is increasingly also relevant, as you probably know, for private equity. So that's the group, and we hope to have an interesting discussion about the Chilean private equity market. But before we get there, I wanted to give a little bit of kind of global context of private equity, what's happening in private equity. So you'll be relieved to hear there'll be only a short presentation, after which we'll get into a discussion of the Chilean market. But this is just a bit of global context to put it, to give us a bit of background. And then the question that everyone is asking these days in private equity is, is it a bubble? Is it going too well in a way for private equity? So a couple of months ago, in April, we did a bit of research and wrote an article, and we came up with a conclusion that private equity is hot, but not overheating. Now, since then, it's probably become even hotter, so maybe I'll say that was true in April. But overall, we remain very positive. Whilst there are good questions about the outlook for private equity, right? And you see some of those questions there, right? People legitimately ask, is the capital being raised? And a lot of capital is being raised, leading to a capital overhang. Is the penetration of private equity in certain markets, I don't think that'll account for Chile, but some of the more developed markets getting too high? Are there enough assets available? And can private equity still outperform public equities? And then what does private equity firms, what do they have to do? So I'm going to just very briefly talk about those questions in turn and give you a bit of a global perspective. And then we'll see how that relates to the Chilean market. Now, the first one is what everyone always talks about is the increase in funds available in fundraising. And here is the dry powder that is there out in the market. And you can see it has been growing, a bit of cyclical, and if you go back further, there's always been cycles in private equity. But there's a lot of money being raised in 2018, by all indications, are going to be even higher. So it's a very legitimate question saying, is there now too much capital? On the other hand, and I've been advising private equity firms for 20 years, I can't remember a time when people didn't have that question, whether there was too much capital. And this would suggest not really. This is a measure to kind of look at the capital available, but divided by the annual investment, right? So how long will it take to put that money to work? And are private equity firms finding opportunities that is at an appropriate pace, given the amount of capital they have? And if you can see from this graph, it goes up and down. There's a bit of cyclicality to it, but overall, private equity so far finding, if you look at historically, how many deals they've been doing and the current overhang, the two are roughly in balance. There's no mismatch all of a sudden where we're having more capital than the amount of money that private equity is finding a good home for. It doesn't say anything about returns, but at least the money is being put to work. The other question about is the penetration of private equity too high? I think this one is quite interesting, because this takes the most developed market, the US, and says how much of the economy is owned by private equity. And it's a large number, depending on the size of the company. It's quite a large percentage that is already under private equity ownership. And if all the money that is being raised gets invested, while nothing is sold, which is not going to happen, but that's like a theoretical upside, it'll go even higher. But I think what's actually more interesting, because I don't know what the right percentage should be. I don't think there is a right number for what this should be or could be. But if you compare it across the world, the US, which is this very developed market where 15% of the companies are private equity owned, if you then take it as a percentage of GDP, in the US, what that means is that the private equity investments as a percent of GDP is roughly about 1.5%, right? But then if you look at pretty much any other market, even developed markets like the UK, pretty developed private equity market, that's like a fifth of that level. So relatively to the economy sizes, the UK is underpenetrated, or could do 5 times more private equity, and then it would only look like the US. And I mean, it doesn't even try to put Chile on that scale, because it's going to be, right there with Japan, I guess, right, with a very, very low private equity penetration. So there's clearly, I don't know what the right number is, but if you look at the US as a leader in private equity, where private equity really started, it would suggest that other markets have more potential to absorb more private equity money than what there is now. And now, the next question is a bit about, will private equity continue to outperform public equity? Now, that's always a very difficult question, and is a key to the overheating argument. So I don't know whether equity markets is overvalued or not. They're certainly highly valued. But the way we'd rather look at it is say, but what is public equity relative to private equity and vice versa? So what you have here is the implied EV multiple, EBITDA multiple implied in the stock market versus what is being paid for at the moment by private equity. And there cyclicality and sector mix changes. We didn't adjust for sector mix. So in the US especially, there's probably more tech stocks in the public markets than there are in the private markets. But overall, and I'm not sure I can explain annual fluctuations, but if you look at the numbers in US and in UK, I think they're closer, maybe because the absence of the tech stocks to the same extent. But this would suggest that private equity, yes, the multiples are going up, but no more so than public equity markets. So to my question, is private equity overvalued? I don't know, but no more than private equity, than public equities. And in private equity, I believe there's a few other things that you can do to generate alpha, which is harder to do in the public equity environment. So although the multiples are going up, as you can see, especially in the US, well, the whole US stock market is having a boom, so I guess it's all relative is the answer. Then I'm glad to say that the LPs seem to agree with me that it's not overheating quite yet. And if you ask LPs, would you increase your allocation to private equity? It looks like we still have a lot of money waiting to be allocated. So from a demand for private equity side or supply of funds, whichever way you look at it, there is the future still looks good, and it doesn't appear to be overheating. No signs of impending doom, and this has supported, as you might imagine, creation of many new firms. And you see this is the number of new firms created every year, and it's at a record high, but not completely out. It's higher than before, but it's not as if it's it's in the realm of reasonableness compared to what we've seen in the past. The one place where you see most of this is the US. Interesting that although it's the most developed market, it's also the North America, we rather say. Although the US, as we said earlier, is already the most highly penetrated in private equity, it seems to be the location or geography where even more firms are starting up to invest in private equity. Whereas the rest of if you look at the kind of the more colored bars, actually there's no signs of private equity creation booming. Of course, this doesn't say anything about fund size. It's just one measure of private equity size. The one thing that is changing is if we look at the sector mix, and it's clear, and also the value. So this is the number of deals at the top, and in the bottom is value. The 2017 number was a year-to-date number, which is a bit out of date, so ignore that one for a second. But the one thing which is happening is that digital and tech is just playing a real role, an increasing role, with more and more money within private equity going to digital and tech. And I'm not talking about VC, I'm talking about buyouts and private equity firms. I mean, if you look at the number of, or the work that we do, both with new deals as well as private equity portfolio companies, and also sell side, I mean, there's always now a tech, reinventing ourselves, taking advantage of tech opportunities, or we used to be known as a, this kind of company, but now we've changed ourselves and we're now a digital company, and that is part of that. Part of that is maybe sell side spin, but it is to a large extent really happening, and private equity is helping to fuel that transformation of their portfolio companies and putting more and more money into digital and tech. Final slide. Just like, well, what does it mean for private equity firms? Well, a few things. This is not a comprehensive list, but they are and need to rethink their organization design. With growth in any organization comes challenges, making sure you have the right processes in place, making sure you have the right governance, etc. We also have having some generational change in some private equity firms, and all of that means that it's important to think about how you organize yourself. You need more sector expertise, so you may want to organize. We've seen a couple of firms, and this may also apply to Latin America, where they used to be organized by country, are now very much having a more of a matrix organization with a very strong sector focus, and I think that's a trend. Some have gone all the way and some have gone half the way, but there's clearly some changes happening there. The tech part we just spoke about, I mean, the skills that people will need within the firms, and also just the investment theses. It's now, you can no longer ignore that and say, oh, that's an upside that I don't have to assess. I'm just going to assess the kind of old business, and the tech part, I don't have to pay, I can kind of ignore that. That's like a bit woolly and it's all upside. It's real now, and people are paying for it. So you have to have the ability within the private equity firm to assess the digital and opportunity, and then you also have to make sure that you have the ability to make sure that realizes and transpires. Otherwise, obviously, you've paid for something which you shouldn't have. Which falls neatly into the last one about the talent. You see, this changes slowly because experience of in the private equity world is super important. But you do see a number of firms, enriching the talent pool, I would say, in particularly with more sector skills, more operating skills, and that's a long trend. I could have stood here 5 years ago and said the same. But now also more digital skills. People hiring people with a very strong tech. Data scientists, that kind of background is also now becoming part of the mix, in addition to the long-standing trends of increasing sector knowledge and operational capabilities. So that was a very quick, trot through private equity, where we are today in terms of the industry. I think it's got as I say, it's a few challenges, but all in the context of I would say a rosy future. So I'm now going to join the panel here, and we're going to steer the conversation a bit towards specifically Chile, and understanding a bit how this all relates to Chile and how Chile is different than what the outlook for Chile is. Thank you. So, very good. So I'm going to start with Raul right away, who's had the longest, private equity, long-standing private equity firm in Chile, and maybe just get your initial perspective to kick us off as to, what has been happening. We'll get to the future in a second, but maybe let's just go to the past, perhaps, in the evolution of private equity in Chile. Where do we stand today, and how have we gotten there?
Okay. First, just as a background, we've been in the last 20 years doing private equity. We started as a Latin American private equity firm. We are a regulated entity in the US, which invest in Latin America, and most of our investors are global investors, pension funds, US pension funds, sovereign wealth funds, regional pension funds, including some Chilean pension funds, as well as family office, etc. And over the last 20 years, we have invested about $3 billion in the region. We have been very fortunate to invest out of the $3 billion, $1 billion in Chile, in about 11 companies, all over, I mean, in different sectors, etc. And Chile has been particularly important for us as a private equity firm. The last 20 years have been very volatile for Latin America. Actually, if we compare what has been the market return, trying to understand the alpha of Latin America, and it's probably not just an investment from day one to the other, to the last day, but investment in each of the moments that we have invested in the companies. The return in Latin America has been minus 2.5% in dollars per year in Latin America. The return of our portfolio has been 5%. So yes, we had an alpha of about 700 basis points all over Latin America. But that compared to the performance of, for example, of the US market, it has been lagging. So there is one issue around that. We have been fortunate to be in Chile because when we take the portfolio in Chile, and I think that has been important, I think also leads the likely evolution of this market going forward, we have invested about $1 billion in Chile. The return in Chile has been about 16% of the market per year in moments that we have been there. So in this sense, Chile distinguished from the rest of Latin America as a more stable market, as a market that has been able to generate returns. Unfortunately, our return has been in the range of 33% per year in the companies that we have invested in Chile. Good companies, bad companies, everything is the average return of our investments. So Chile for us has been an important source of return, an important source of alpha. And we think that this trend, although probably as the markets mature, it will be probably fading out and reducing a little bit, it definitely presents a very good opportunity for private equity for different groups in different areas. We have invested from companies closer to infrastructure like water, utilities, to retail or whatever, in different sources. I think overall it presents a very good future for different groups.
Yeah, yeah. And if you now start thinking about Chile's role within South America, maybe Carlos, I can ask you, how do you see, the difference between taking a Latin American approach and a Chilean approach? How important is Chile in that, and how is it different if you think about investment strategies regionally versus nationally? Are there differences that you consider? How does Chile stand out for you, shall I say, versus the rest of the region, positively or negatively?
Well, speaking specifically about infrastructure, which is what we do. So I'd say that we've been focusing in Chile since we started the company a couple of years ago. So I can speak more intelligently about Chile and the rest of the region. But when we see the challenges that we face when we try to make an investment and compare it to what we usually see as what are the challenges or the issues that global investors complain about in the global infrastructure market, we see certain differences. For example, the three main issues that investors complain about when you see reports in infrastructure are valuations, deal flow, and regulation. Right? Those are like the main three. In terms of valuations, well, you can always complain. But in our view, if you go, there are certain spaces in the infrastructure market where valuations are not too high. You have to look into smaller equity tickets. If you go to the 500 million equity tickets, then it's pretty crowded. A lot of the global infrastructure operators are trying to get that deal. But if you're looking at tickets between, I don't know, 40 or 30 to 70 million, which is where we have been active so far, it's much less crowded. And also, if you go outside the traditional infrastructure, which is public concessions, you can also find better valuations and higher expected returns. That's with regards with valuation. If you go to the regulation part, to be honest, it hasn't been an issue for us. We think that the regulation in general, we have different regulations for different asset types in infrastructure in Chile. But in general, there's not much that we complain about, when you look at the track record in Chile. There has been always respect, even though regulation can change over time, there has always been respect for the economic equilibrium of concessions. So it's not that big an issue for us, for our investors. And about deal flow, the truth is that we cannot complain at all. The last 2 years, we've been able to see at around 20 deals per year. That's much more than what we expected when we started. Of course, most of them, we just discard them right away. But we've closed 3 deals in the last 18 months. So I think it's a very interesting environment.
So we've heard now from the private equity and the kind of infra side that Chile has been and is an attractive kind of for private equity investment. So I'm going to ask both Jose and Cristobal kind of, so why haven't you invested more? Or is there what's keeping back the private equity market? Maybe that's another way of phrasing it.
Yeah, I can. Is it working? Yeah, sure. I can start. I think it's part of an evolution on the investment process. For instance, pension funds used to hold about 30% of our portfolio in public stocks, public Chilean stocks. Nowadays, it's about 7%. That's because our funds grew significantly, and we started looking for additional opportunities to invest our money abroad. And nowadays, most of our new money goes internationally because it's where we found more diversification and opportunities. I think with private equity has happened something similar. We started investing in local private equities, which in reality they are not many companies. There is Southern Cross, there is Linsor, like pure private equity companies, and probably I'm missing one, but not many. So we started looking for the international big names, and we are highly diversified and invested in the usual suspects, the largest private equity companies in the world. And 2 years ago, the Congress approved a change in regulation, which really now allow us to invest not only in private equity, like traditional buyouts and those type of private equity, but also in infrastructure and commercial real estate. And we are starting to look at a lot. We're very attracted to that because the return of our funds, even though have been extraordinary during the last 35 years, it's inflation plus 8 per year on average, which is great. But when you analyze it, you see that the returns have been coming down because the return of the assets in the world have been coming down. So we need to look for new asset classes, and alternatives is probably the best fit for our portfolio. So I think it's part of market evolution. Now that we are going to be much more active investing in alternatives and in private equity, I'm pretty sure that there's going to be more companies coming into the market, even local or internationally, because as pension funds, we are going to invest probably in the next 3, 4, or 5 years in the range of $15 billion in alternative assets. And I think that's a lot of money.
Morning, Andrew. Well, I'm going to give you our global perspective into how Chile fits within a portfolio. We are invested today at around 1,600 funds all over the world, and order of magnitude, Latin America represents circa 1.5%. Latin America is 1.5% of the global actual private equity world. Latin America is an $8 billion private equity market, roughly both in investments and in fundraising. And it has been that since 2010. And regretfully is actually tailing, and it's not growing for a number of reasons. If you put that in context, Chile represents roughly 6 to 7% on an investment amount of that 1.5% global, or $8 billion, when you look at it since 2009, I would say. Has ups and downs. The last 3 years for Chile have been very good, although from very small amounts, the investments have doubled from 2015, 16, 17, when you look through the numbers, both private equity and infrastructure. But it's small, and particularly it's small when you look at the fundraising for domestic private equity groups. I believe one of the main issues we find is finding groups to back when we were looking to deploy capital in Chilean private equity. As Cristóbal just said, there's not that many private equity groups in Chile to invest money with. I'm not saying, I'm sure there are plenty of growing and starting groups, but have not been able to fund themselves and come through the ranks into a more global scenario, or even domestic, where groups can invest checks that are in excess of $10, $20, $40 million. And that restrains our ability as an investor to deploy capital. So on the one hand, I think there is a demand issue from the groups seeking for capital. There's only a few, and they're regional. And on the other side, I query if there is capital to fund those local groups. When you look at the region, particularly Peru, Colombia, and Mexico, which are now 10 years into their domestic private equity programs, you'll find that regulation has pushed pension plans into the domestic private equity asset class in what was perceived, and this depends on each country, into the intention of developing the private equity ecosystem, which has some consequences, of course, on the early days. And now when you look through that and you look the penetration of private equity, the metric that you showed us to be 1.5% for the United States, is even higher here in the UK. Chile has 0.1.5%. In comparison with other countries, like the ones that just mentioned, that not only have higher penetration, but they're growing faster. So maybe long-winded way to answer your question about why we have not deployed much capital in Chile. The fact is, the industry is relatively small on an absolute and relative basis. And from our perspective, what we would like to see is an emergence of new managers raising mid-sized funds, growing into the asset class. Like, for example, is Toesca in infrastructure. Started 2 and a bit years ago, now successful, making 3 investments in 18 months. They're finding capital, shortly fund a permanent vehicle. And I don't see that happening much on the private equity world. It's only a handful or 2 groups.
So, I mean, I think the larger funds maybe inevitably will always be regional. And if you look at Europe, larger funds are, and that's fine. But it's also good for you if they were local country funds. If you look at Europe, half the deals at least are secondary transactions. So, if they were smaller country funds, it'll be even good for the regional funds. So what do you think is holding that back? Or what can be done to encourage, to further grow and foster the industry?
I think there is a sweet spot in Chile that has not been really seen properly. The fact that, our experience, being having found in Chile a nice place, although a small market, I mean, if you see from a regional point of view, the first markets that capture attention are the large markets, Brazil, Mexico. Whenever those markets have some cyclicality or whatever, I mean, the whole region enters into some questioning. But Chile has been extremely consistent. So I think, I mean, going to for example, José's question, I think there's a lot of opportunities to be developed. But we have to be realistic. I mean, in your chart, I mean, Latin America is within rest of the world. And Chile is a percentage within Latin America. So, yes, local pension funds, for example, are global investors and have a global portfolio, as Cristóbal says. So we should expect that probably there would be a percentage for within its asset allocation for alternatives, and within alternatives, private equity, infrastructure, and within that would be a percentage for a specific market like Chile, probably with a little bit of overweight given the knowledge, etc. But I think there is a very big opportunity to develop the market. I mean, to have new people come, to have new deals, and it's part of an evolution. I think I tend to think to see the glass half full, and I think we are in that trend. I mean, the fact that there are groups developing opportunities like Toesca in infrastructure and in different areas. Probably in the venture side, we've seen a lot of activity, and we see a lot of people working there. We need, like the second stage, I mean, companies that entered into more the mid-market, and they need that jump. We need that other players appear there.
From our, if I may jump in,
please.
From our point of view, and again, talking specifically about infrastructure only, the reasons why there hasn't been more activity from local funds, given that there has been a lot of market activity. I mean, deals have been done. We've seen an average of 7 to 8 deals a year, amounting around 1.5 billion in infrastructure for the last decade, every year. But most of it, I think close to 85% of those deals have been done by foreigners. I mean, they have been the buyers, either strategic or financial buyers. And only about 13% has been done by local financial players. And out of that 13%, probably just half of it have been local funds. So it's a very, very small amount. And the problem is that, so even though deals have been out there, there hasn't been money available to be raised in Chile, because raising money from the rest of the world, being part of the rest of the world as we are, it's pretty hard. And from Chile, there has only been a handful of life insurance companies and family offices that have been the backers or the investors in those 1 or 2 funds that have been active. So now, with the change in the investment regime of the pension funds, we think that it's basically the lack of money from the pension system that hasn't been out there because there were no incentives in the regulation. That for us is the main reason, because without that, you don't see new funds being raised. I mean, if if you don't see that the money is going to be there, there are no funds will be raised.
So it sounds like you may see some momentum from new funds become available, but at the end of the day, Chile will still have to compete with the rest of the world for that money, right? It's not that you have to put the money into Chile. So I was wondering, I mean, maybe I'll start with the people who have who provide the funds first again. I mean, how do you see the attractiveness of Chile as an investment in private equity versus the rest of the world? I mean, is there something you think why Chile is either more or less attractive, or private equity is not somehow suited to Chile, or the regulations are in a way, or you know, is it a fertile ground for private equity, do you think?
No, for private equity, we try to look the whole world in reality, because it's an asset class that we can compare, same as equity, same as bonds. We're always analyzing what are the expected returns that we can get in Chile, in the rest of Latin America, and the rest of the world, because nowadays we can invest all over the world, and we're looking for the best alternatives. Of course, in other areas as real estate, infrastructure, some private debt, we might have a more local focus because we also have an interest in developing our own country. At the end, we are managing as Provida the savings of more than 3 million people, 3.5 million Chileans, and of course we want that money to serve our own country, and if there are good opportunities, we are going to look for them. 2-3 days ago, Minister Fontaine, who's the Secretary of Public Works, yeah, thank you, announced almost $14 billion for the next 5 years. Of course, you never know which percentage of that is going to really come into place, but it's a very large amount, and of course, as pension funds, we're willing to participate in that development of the country and those kind of investments. And we're pretty sure it's going to be very good for the country and for our affiliates and for the returns of our funds. But going back to your previous question, I was looking at the Yale endowment allocation, and it's amazing. They have 50% in alternative assets, 50. They have 17% in venture capital, and we don't have opportunities to invest, probably not 0.5% in Chile in venture capital. That's something that we're looking to promote other industries, to promote other ideas, but we still need to push a little bit the industry to get developed. There's some restrictions in the new regulation. For instance, we only can invest in companies that have 10 years of track record in Chile, local companies. It's very hard to find a venture capital with 10-year track record because of the nature of the business. But I think things are going to keep evolving, and should be new opportunities.
I think you were saying with more opportunity, more funds would solve half your problem. But if you step back and say, well, if they were there, how would you think about Chile as a market?
Well, in summary, I like it. We like it. At Lexington, we think that Chile provides, I think the word Raul used is predictable. And I think Chile is more predictable. It's less volatile. And when you look into allocations to emerging markets, and ultimately as a financial investor looking for a risk-adjusted return, and let's leave the return aside because most emerging markets have the underpinning secular trends that drive growth, demographics, and a host number of other reasons. The risk side of the equation, Chile scores the highest, certainly in Latin America. Factors like currency volatility, regulation for the underlying companies, with some exceptions, of course, in the last 4 or 5 years, particularly around education, for example, and the rule of law are critical. If any of those three variate substantially from the base case, the underperformance of the underlying investment is out of the GP's hands. It's not about how good or bad they are. It's just the lay of the land. And at least for what we've seen so far, Chile has managed to deliver performance, like in Southern Cross, best performing country to its peers within the Southern Cross countries they operate. And we see something similar within our funds. I'll say there is less volatility but less spread within the returns. But primarily what we like the most is there is less what we call loss ratio. There is less loss, absolute and relative. And that is one of the most attractive factors, at least for us, from an investment in private equity in emerging markets. Because any loss of 1, 2, or 3 companies wipes out the 2 or 3 baggers on a portfolio. So we like, I think Chile has the potential. I think Raul is correct in what he says. And if there were to be more groups, I think those groups would be successful in delivering performance. I think we are in a chicken and egg situation right now, like in most countries that are developing their private equity ecosystems. And the capital, not only AFPs, but also insurance companies, families, need to understand what path they want to take as to developing the ecosystem, because it is an investment, and it arguably has to be done in order to, for example, pick up on the venture capital companies that Corfo's been funding for many, many years now, that they now need to be picked up into the growth category. And we see that there is a lack of investable capital.
So the investors seem to like Chile as a private equity opportunity. Maybe I ask the two of you about for infrastructure and private equity respectively, what does it take to be successful in Chile? Where in the private equity value chain is it the deal sourcing, which is the crucial part? Is it the execution of the deals? Is it the structuring of the deals? Is it the value add afterwards? What do you think are the critical the things where you feel that it's very important for you to perform and will drive your success as an investor in infrastructure in Chile?
I'm not going to give you a magic formula. It's very basic. So one thing is being able to create proprietary deal flow, right? Not just relying on what the investment banks are going to show you. And we've been dedicating a lot of resources and time trying to do that. And in order to do well our job, we believe there are three things that we need to do well. One, be good at M&A, so being good at not just making a good analysis, but making a good due diligence, making a good negotiation of an SPA, reps and warrants, stuff like that. It doesn't. You not only need to be good at understanding the asset operationally, you need to be good at acquiring it. A lot of the mistakes you can make are done at the acquisition stage. So that's one thing. Second thing is understanding, again, the operational side. So being able to not necessarily operate, because we rely a lot on operating partners, but being able to control them properly and to try to bring efficiencies to the operating company and to your partner. And third thing is being a good minority stakeholder. Because most of the time in infrastructure, you're going to find yourself being that. And for that, you need to be good at negotiating a good shareholders agreement, managing well that shareholding agreement, and most of the time, you're going to be controlling conflict of interest. Because most of the time, you have a partner that is not only your partner, but it's also providing services to the operational asset. So those three things.
Probably our case is kind of the opposite in the sense that we take control positions in companies. So we have to take, I think I completely agree that the first stage, which is the acquisition side, is very important. Doing the acquisition, being very disciplined in that process. But in our case, the value is part of the value that is created there, but most of the value and the difference is created once you are in the company. And being able to create value on a sustainable basis at the company level. And I think that what's going on a more broad sense, it's also impacting the type of key variables that you have as a private equity. Things that, of course, value creation is very important, attracting talent. Today, attracting talent is key, and attracting the right type of talent. You mentioned digital. Digital is not only that today you have companies that are on the IT side, but I think every company is seeing their business model being reshaped whether opportunities or risk, and you have to think differently. So bringing people that will help you address that is very important. And I think that's a key element right now, I think, of value creation, on top of what has the usual things. Compliance. Compliance is key. I mean, today, compliance from an environmental, regulatory, corporate governance point of view is very important. And this is something that is going to be very relevant and increasingly relevant in our ecosystem, entrepreneurial ecosystem, and particularly private equity ecosystem. So I think that many of the trends that we see globally are present in Chile. And the only difference is that we are still in developing our ecosystem. I like the word that was used because it requires a lot of coordination and exchange of ideas, and probably there will be new ideas, some implemented, some will be mistakes that you have to go back and change them, etc. But that's very important. I think another element that I think is important in order to develop the ecosystem in Chile for private equity is to have what we have seen with our, especially global limited partners, is that they like to take a very special role at advisory committees, to be close to the investments, to be close to the advisory committees, and that, I think, creates for them a lot of value for limited partners in order to follow the right groups, to be close to what's going on, etc. So I think that in the development of that ecosystem, I think the relationship between general partners and limited partners at the advisory level is important, and probably this is part of what the ecosystem and is going to what we are going to see in the future.
And what's the perception of stakeholders, shall I say, in private equity? As it gets bigger, it's going to attract more attention as well, right? Yeah. More scrutiny, you know, but you also, I mean, and therefore it's also important both what people think of private equity and its role in the economy to attract not only funds, but also to make sure that regulators think of it in the right way, to make sure that entrepreneurs want to be part of it, to make sure that companies want to sell to it and partner with it. I mean, what's the perception of private equity, and what do you think is what should be done? Is anything should be done to manage that perception?
Yeah. When you talk about perception, I mean, usually it's based on the latest news you have. So it's funny because the perception is kind of a mutant that depends on kind of the latest flavor of the month. I think that perception of what private equity is something that is not clear yet into the market. It's actually a group of professional investors that invest in companies that have a very strong sense of fiduciary responsibility with its limited partners. So sometimes that sense of responsibility with limited partners move the private equity to be very diligent and be probably less prone to the flexibility that individual entrepreneur may have, because of but on the other side, it provides a lot of discipline in the way that you have to address the issues at companies, the issues with relationship, as Carlos says, with partners, with different people. So I think we should be seen as a reliable partner in the sense that we have a set of a framework where we can move. That's one element. And I think that initially probably it was seen more as less than a professional investor that has this type of set of rules, and more as a entrepreneur or group of entrepreneurs investing. That's probably the evolution of And now I think there is a challenge from a regulatory point of view, from several points of view, of how to monitor this ecosystem. I mean, we've been regulated, as I mentioned, by the SEC and the Dodd-Frank Act for many years, and we see a very reliable and very predictable regulation in markets that have this development in the past. And probably in Chile, that would be the challenge, to develop and to adapt and to create a good regulation, something that Chile has been able to do it in so many sectors. And I think that the fact that we have predictability is because we have a clear set of rules, and those clear set of rules allow to address, especially on the product market. And so I think it's probably right for the period of the life cycle of this industry.
Yeah, so you've got a very influential audience here. So this is the time to kind of influence people if you wanted. So I wonder, when it comes to regulation, do you think there's any kind of evolution that is required to further boost? I mean, we're stuck in this chicken and egg kind of thing, right? So how do kind of accelerate it? I don't know, any regulational kind of trends you think would like to encourage?
I'm happy to take the lead. I see that the policy board of LAFCA, which is the Latin American Venture Capital Association, and we oversee regulation across the region. I agree with Raul's point in the fact that you need to regulate the industry properly to avoid the issues that the region has encountered as these domestic groups were growing into institutional GPs. I think in some cases, some countries went in too aggressively, i.e. they allowed pension plans, highly incentivized pension plans, to invest in domestic private equity without having proper regulation around the groups that were raising this capital. And that resulted in governance issues, underperformance, and a number of other reasons, terms that were not international sort of market standards, economic terms for the GPs and so forth. Chile is at the forefront of regulation. They started the private pension plans, what is it, Jaime, 25 years ago?
38.
32? 37. Great. I barely was born. You're right. The point I say is, Chile is, what I've seen is in my experience, is that they have a group of professionals that, and the government, working together on round tables that come up with very well thought and well put together regulation. I would like personally to see a regulation that makes sure that domestic groups are properly kept in touch, yes? And I would like to see also regulation that incentivizes different stakeholders, different institutional investors, and families to invest in domestic private equity. I think it's unfair to put it all to the pension plans like we always do. I think it's unfair to us families to be the only supporters because they are heavily invested and many times compete with some of these groups. But I'd like to see that coming together into regulation without, based on what we've seen in the region, without local investors funding the ecosystem doesn't take off. Because international LPs will say immediately, how do you expect me to invest $1 in your country if no one from your country is investing with you? And that's a natural reaction, unless you have a track record that doesn't need any further explanation. So that's my take on regulation. I think Chile can do it, and it should sort of put focus on the industry. It's not an industry that actually the government put a lot of focus on. They put more focus on venture capital, naturally so, R&D. But if you really want to develop this ecosystem, you need regulation to push investors in and to regulate the players.
Yeah, from the point of view of the pension funds, as I mentioned, we just have a new regulation in place. Actually, we were approved by our regulator 2 months ago to start investing in alternatives. So it's a kind of new process for us. Even though we've been investing in alternatives for probably, we have funds that have some 30 years old, and we've been more active in private equity for the last 8 years. But this new regulation took some years where we basically stopped investing until we have some confirmation of how the treatment of the investments were going to be. We think the new regulation is a very good one in the sense that it allows us to look for new alternatives and new investments, but at the same time, given that it's new and it's a new asset class for the regulator and for the pension funds, there are going to be some little adjustments that we will have to do in order to make it feasible for the market. Also, there is a building process of trust between partners. When we invest in a company, when we are shareholders, we are partners of that company. When we are bondholders, we are partners. And when we invest in an illiquid asset as private equity or infrastructure, it's a much complex process, because if you make a mistake, it hurts much more because there's not many places to hide. So we take a lot of time knowing our partners, understanding their philosophy, understanding what their plans are, what their track record is, what are they thinking to do, and hopefully we look for companies that are good at something and that they keep playing in their same field. Sometimes we get scared that a private equity fund is very successful, raising $2 billion, and then they work in SME sector, and then they want to go to a large buyout with $15 billion. That's kind of scary for an LP. So it takes time. At the same, we also need a lot of transparency and good communication, and the companies to have very good corporate governance. That's also very important. That it's something that with the fiduciary role that pension funds have, we push very strongly on all of our partners.
Let me raise one issue that I think is important. Let me do a comparison with banks. For me, banks, I mean, I think it's an extremely complex business. You have very low interest rates or very low spread to our standards, and you have the risk of a loss. So good banks, what do? They're good at lending money, but they're very good at working out problems. And they work out problems early on. They're able to manage that. And that ecosystem, that banking ecosystems, requires that banks are good at lending and are good at working out problems. And the problem with private equity, and that would be a problem, is that for obvious reasons, there will not be absolute, in a specific fund, absolute diversification. I mean, diversification will be 10 investments, 6 investments, 20 investments, but no more than that. So the ability to do workouts, and when I say workouts, is because at the end of the day, what you were saying, Jose, the total loss in an investment, but there will be, I mean, there will be successful investments, and there will be investments that will be lower performance than the average. That's life. So the ability to do workouts in the sense that try to develop and make money and reduce losses is very important. And that reality needs to align on all interests. So if we think, I mean, if we have, and let me, for example, in case of regulation, if regulation is very much focused on the workout cases, and not as much in the other cases. I mean, you have a bias. So if banks were just focused on the workout situations, you wouldn't have a healthy banking system. So I think that, for me, that analogy from the banking world, I mean, needs to be incorporated into the into our mindset, into the mindset.
Yeah, sorry, and about that, for pension funds, we are under a lot of scrutiny because obvious reasons, because we manage third-party people. Yeah. But at the same time, the public as well as regulators, it's very complex when there is an investment that loses money. And specifically when it's a Chilean investment that loses money. I mean, there's a huge attention. We have had cases where we have 0.1% of one of our funds invested there, and it dragged almost 100% of our resources explaining and analyzing. And it's something that when you're investing and you're looking for good returns, sometimes some investments doesn't perform the way you were expecting. It's part of the risk-return equation. So I think that also we need everybody here, the whole community, the press, the public, the regulator, everybody needs to understand that now that we are entering into a private equity world where you expect much higher returns, we are going to face losses. Unfortunately, it's something that it's within the probability. So that's also that we have to educate people. We have to educate our community, because otherwise, what we do is that we tend not to take that risk, because the headline risk is that expensive that you don't want to have your whole team answering for a 0.1% investment.
So I want to ask kind of one final question. The one advantage of a panel is, there's no slides. We can just talk, which means I'm going to ask you to dust off your crystal balls and say, now, if you say 5 years from now, if you then think, where will the Chilean, what will the next 5 years look like for the Chilean private equity market? Returns, structure, does it grow? Does new players come in? Does the structure change? How do you think it will look different? And what will the next 5 years look like? And you can comment on any of the dimensions that you wish. And maybe I'll start with the infrastructure first this time. So what do you think the next 5 years look like? Will there be more infrastructure investors, more funds, more opportunities? What challenges? Good time, bad time? What's coming for us?
So in terms of opportunities, we think it has been a good market for the last decade, and we think it's going to keep that way. Not necessarily it's going to be much higher, probably in terms of new PPP projects, new concessions being done by the Ministry of Public Works. Probably that is going to be to pick up a little bit. It has been lagging in the last 5 years. But what is certainly going to change is that 85-15% a relationship between foreign buyers and local buyers. I think that's going to change for sure. I don't know how quick that's going to happen. Probably it's going to take time because of what Cristobal mentioned, because pension funds are not going to be throwing money at institutions like ourselves to invest right away. It's going to be a slow process. But 5 years from now, we're pretty sure that there are going to be more local funds investing in the sector and taking a larger chunk of that, larger than that 15% that I mentioned before.
Raul, 5 years from now?
I agree that there will be more groups, and I think there will be a more globalized approach in the sense that the new funds probably will be with local investors and pension funds, etc., as well as global investors. I mean, and that I think is part of the evolution that we can see. I think that there are great opportunities to invest in the market. That has been in the past, there will be in the future. There is the whole infrastructure space that is being open. I think they will bring more competition to the industries. We may get some surprise that a big company may be taken over by a private equity firm, something which until now has not been so closer to what's going on in global markets. I think it will be maturing. It will be a part of this evolution of the ecosystem with a balanced approach between regulators, etc. But I think it will become more global from a sourcing point of view, capital. I mean, local capital, international capital, and also some international players starting to see Chile as a small, interesting group to invest. Because a small market, but what I've been hearing from the last 20 years that Chile is very expensive. And Chile has maintained very expensive, but has been able to sustain higher returns. The fact is that we have a more developed capital market. And what Invest does here is to promote, and the development of the capital market has promoted that, a more stable business. And I think that will maintain and will consolidate in these other asset classes.
I think it's going to, I agree that Chile will gain share of Latin America by virtue of the long-standing performance. We just saw a fund like Advent doing a deal in Chile. It's relatively new, and we might see others as they find that the typical countries where they used to make a portion of their investments are no longer that attractive. Now you gain share of a pie, which is Latin America, which I think it's under a severe test right now. There are contributors like Mexico, although with no small degree of volatility. And there is Brazil. Unfortunately, for us non-Brazilians, Latin America in the eyes of private equity is Brazil. I know that some look through and get to Raul, but the fact is Brazil is very important. So we've seen a loss of appetite for Latin America within investors. Those percentages of increasing shares, I think if you double click and you go regionally, what you will find is that Latin America is still a question mark. There are more, I'm going to say sophisticated, but certainly more risk taker investors, US, Canadian particularly, that are able to take on risk, Latin American risk. But broadly speaking, the large passive LP, it's still maybe one step behind into investing into private equity in Latin America. And hence that pie is fairly unchanged. Yeah. So what I'm trying to say is if Latin America takes off, I see Chile growing. And that would be a great opportunity for regulation to underpin local groups to take a share of that. And Invest should be behind those domestic groups, taking them into the rest of into the world in order to seek capital and pitch. If Latin America does not perform for whatever reason, on an absolute terms, Chile will struggle to keep growing because it will be gaining share of a contracting pie. I hope it's the latter. I run Latin America for Lexington, so that's kind of like I'm biased. But I hope that the whole I think I trust investors start seeing what I see, which is value in Latin America, and which is less hot than the rest of the world. And we manage to keep politics and volatility at a level, which will always be here in Latin America, that investors can manage. That's my take.
Final word to you.
Yeah, for the next 5 years, I'm pretty sure that we are going to significantly increase our investment in Chilean private debt, which is an asset class that we haven't been yet. We're also going to push the the investments in venture capital, local venture capital. We would love to see, as we saw in the previous presentation, there's a whole world of entrepreneurship in Chile developing, and we want to be part of that. It's still very small, but we think we can be a supporter of those initiatives. And of course, infrastructure and commercial real estate is something where definitely we're also going to increase our allocation. Private equity is an asset class where we've been investing for more than 8 years, and I'm sure we're keep doing that. Hopefully there are more local groups or regional groups that develop. Actually, Raul invests in all Latin America. It's not just a Chilean company, and we're willing to do that. But for sure, alternatives and private equity is going to be a larger stake of our investments.
So it's good to hear we're finishing on a positive note from everyone with a bright outlook. Thank you very much. Thank you very much for your time. Much appreciated. Thank you. Thank you.